Post-Monetary Policy Committee press conference. The Monetary Policy Committee held its meeting yesterday, Monday, the 26th of June. And as is customary, today we'll listen to the Governor of the Central Bank going through the rationale behind that decision. We'll also, within this press conference, be able to take your questions on that decision and the rationale behind it. Now, for today, there's slightly different rules, and I think I've briefed quite a number of the members of the media. We shall be taking questions strictly around the MPC and its decision and anything adjacent to that, meaning issues of the economy and the rest, because we will have a more generalized press conference within the next couple of weeks, at which we will make it a lot more general for those kind of questions. So for today, if you're able to keep your questions to issues of the MPC decision and the economy, we'll be glad to do so. As usual, the hashtag is hashtag MPC0623. That is on Slido, www.slido.com. Put your questions there. Please make sure you introduce yourself by your name and your institution so we can take those questions in the context in which they are put. But for now, we want to welcome and introduce the Governor of the Central Bank of Kenya, Dr. Kamau Thuge.
Thank you very much, Wallace. As most of you know, the Monetary Policy Committee did meet on May 29th. There have been some questions have been raised as to why we are again meeting why we met on June the 26th. When the Monetary Policy Committee met on May 29th, they had the information that they had before they made the decision to maintain the CBR unchanged at 9.5 was a situation where the inflation rate seems to be improving and the prospects for lower inflation looked quite imminent. The inflation rate when they met had actually declined from 9.2% in March to about 7.9%. And that reduction actually in most of the items in the CPI did actually decline. For example, fuel prices had declined from roughly 13.4% to 13.2%. Food prices had also declined quite significantly from 13.4 to roughly 10.1. And equally important was the non-food, non-fuel price that had reduced from 4.4% to 4.1. So from that perspective, the Monetary Policy Committee then was of the view that inflationary pressures had decreased and the prospects going forward were quite positive. In fact, at that point, the CBK had anticipated that inflation for May even be within below the upper range of the CBK target of 7.5 and had anticipated that it would actually go to 7.1. So on the basis of that, the MPC, the Monetary Policy Committee, therefore decided to leave the rate unchanged at 9.5. So I think that was the right decision at that point, given the information that was available then. Since that time, we then received information on inflation for May, and that information indeed indicated that inflation had accelerated, and instead of it going to 7.1, it had actually going to 8%. And again, most of the items went up. Food prices went up, fuel prices also went up, and core inflation as non-food and non-fuel also went up. So at the time we met, we felt then with these upward pressure on prices and also prospective increase in inflation, that it was necessary that the Monetary Policy Committee meet again on June 26th to have another look at the prospects for inflation going forward. And it's on that basis that we called this meeting on June the 26th to review the inflationary situation given the new numbers. So that was just to give you a background as to why we had a meeting of the MPC, basically that was called before the next cycle of meetings, which is expected to be in July. So with that, let me now try and give you a presentation on the factors and the reasons that went into why we had to raise the CBR rate from 9.5% to 10.5%. The MPC noted sustained inflationary pressures and increased risks to the inflation outlook, elevated global risks, and their potential impact on the domestic economy. The MPC thus concluded that there was scope for further tightening of monetary policy to anchor inflationary expectations. And let me just add here that obviously the mandate of the central bank is to implement monetary policy with a view to containing or stabilizing prices. And in my view, inflation is almost like a tax because it reduces everybody's real incomes. And so it's very important that we address the inflationary pressures with the idea of actually reducing the cost of living. And as you know, the cost of living is one of the issues that has been concerned the country, and therefore it is critically important that we address inflation because everybody is affected by inflation, and everybody, even those who don't have incomes, are affected by inflation, and therefore we must address inflation and address and anchor inflationary expectations. So the Monetary Policy Committee will closely monitor the impact of the policy measures as well as developments in the global and domestic economy, and stands ready to take further action as necessary. So the committee will meet again next month, July 2023. So let me go to the global, look at the global environment and start with the inflation. Inflation in advanced economies has been easing, but has remained above respective targets with persistent core inflationary pressures. The headline inflation has been declining with monetary policy tightening and lower commodity prices. Core inflation has remained elevated due to the strong service price increases and cost pressures from tight labor markets. Let's go to the next. So with regard to commodity prices, you can see that oil and food have continued to ease, mainly due to improved supply and weaker demand. The price of oil has declined with weaker demand, but remains volatile due to increased uncertainties to global growth. And you can see there Murban oil prices as of June 1st was at US $74.7. On food prices, these have also declined with the rebound in global supplies and the extension of the Black Sea Grain Initiative. However, sugar prices have been rising sharply due to the reduced supply. And this chart that just indicates that the global freight transportation costs have been declining, and this is the index for 40-foot container. So there's been a persistence since about September of 2021. There's been a consistent decline in those costs. So looking to the global economic outlook, we see that in terms of the world growth for 2021, the global economy grew by 6.3%. And since that time, of course, this was a recovery from 2020 when globally we were all affected by the COVID-19. So last year it grew by 3.4%, and it's expected to slow down to 2.8%. These are estimates from the IMF World Economic Outlook that came out in, I believe it was in April. But you can also see that the prospects for the United States growth was 5.9 in 2021, decelerated to 2.1, and we expect a further deceleration to 1.6. And it's good you note this as we later on look at the balance of payments and look at the prospects for remittances from the United States. At the bottom of that table is the Kenyan story, and you can see in 2021 the growth was 7.5. I think that has since been revised to 7.6, and then for 2022 the growth, I believe, was 4.8. But essentially you can see that even with a slowdown in Kenya's growth, it is higher than the sub-Saharan average. It is higher than, and of course it's higher than the global average. For 2023, we will come later to the estimates for Kenya's growth, based not on the WIO, but based on what the central bank has been doing. Regarding domestic inflation, we can see that, and as I noted a bit earlier, there was an increase in overall inflation in May of 2023, driven by higher fuel, food, and non-fuel prices. And if you just focus on the last two, April 23 to May 23, you can see that the blue column, which is food, increases from 10.1 to 10.2, and we'll have a look at another chart that explains exactly which food items were driving the inflation somewhat higher. You can see fuel increases from 13.2 to 13.6, and importantly, we see that the non-fuel has increased from 4.1 to 4.3. And that 4.3 is almost at the peak if you compare it to February 2023, when it reached a peak of 4.4. The next chart just looks at the contribution to overall inflation of food, fuel, and non-fuel. And just looking at the last three columns, actually, you can see that just focusing on NF, the non-food, non-fuel, that the contribution in March was actually 1%. The contribution from fuel was 3.2%, and the contribution from food was 5%. The reason I point that out is to see that in the next 2 months, that the contribution to inflation from non-food and non-fuel has actually increased from 1 percentage point to 1.3 percentage points, whereas for fuel it has declined, and so has the food prices. I distinguish between non-food, non-fuel from fuel and food, because to a certain extent the monetary policy, central bank's monetary policy, has more direct impact on non-food and non-fuel. And so we'll see whether there's another chart that shows actually the development of non-food, non-fuel over the years. In fact, this is it. You can see that the non-food, non-fuel inflation has increased, indicating persistent underlying inflationary pressures in the economy. And you can see for quite some time, from actually from August 2019 to only recently, perhaps even June 2022, that non-food, non-fuel inflation was actually below 3%. And below 3% is what we believe is consistent with an overall inflation of 5%. So the fact that we are now above 4% is very high and shows persistent inflation, and that's why explains part of the reason why we had to take very strong measures in order to contain this inflation and to address inflationary pressures. The next. And this one just indicates what the main drivers of food inflation are. If you look again from April to May, we can see that what is actually driving the food inflation from 10.1 to 10.2 is actually vegetables. Non-vegetables have actually been declining. I think we have a chart that is coming up that will show you the developments in prices of non-vegetables. But here you can see between April and May, you have an increase in the contribution of vegetables from 1.4 to 1.9. Whereas the contribution for non-vegetables actually declines from 8.7 to 8.4. So this is the main drivers of food inflation. I think I don't need to go into too much details. Let's go to the next slide. So this is the contribution of prices of we've looked at the 4 key food items: wheat, maize, milk, and edible oils. And you can see since about September of 2022, there's been a downward trend in the contribution of these 4 items into the food inflation, and obviously also into the overall rate of inflation. Right now, if you look at May, for example, these 4 items contribute 1.2 percentage points out of the 8% overall inflation. And this is quite low compared to the peak of September 2022, when actually almost 50% of overall inflation was coming from wheat, maize, milk, and edible oils. So this is just a focus on sugar prices, because sugar prices have shown a trend of being very high. And you can see that the 12-month inflation for sugar is actually about 50%. That's very high. And just sugar itself is contributing to the overall inflation by 0.7 percentage points. Now, expectations, inflationary expectations. We were very concerned about inflationary expectations, and the reason why we were concerned is if you compare what the respondents in this survey were saying between May and June. Take, for example, during May, the respondents who were expecting inflation to decrease in the next 1 month. And you can see there the 25.5% of respondents were expecting inflation to come down. In the survey for June, that 25.5% has actually declined to 11.1%. Similarly, for those who are respondents expecting over the next 3 months inflation to decrease, during May it was 43.8%, and that percentage has declined all the way to 26.4%. And so that has actually fed into respondents expecting higher inflation compared to May. For example, those who expect inflation to rise in the next 1 month has increased from 44% to 61%. And those expecting over the 3 months, it has increased from 42.5 to actually 54.2. So again, this was a major concern of ours. We want to anchor inflationary expectations. Indications from respondents was actually the opposite, that people were actually expecting inflation to continue to accelerate, and therefore it was very critical that we take action to address this change in inflationary expectations and hopefully anchor those expectations so that people don't make decisions on the basis of expecting inflation to accelerate. On the growth story, here you can see that the overall growth for this year, we expect it to be around 5.5. That is the last column. And this is an increase from the 4.8% that was recorded last year. And the main story here is that we expect a recovery in agriculture. It contracted last year by 1.6. This year we expect an expansion in agriculture. I think the rains have been quite robust so far, and so therefore we expect agriculture to recover. We also expect services to remain robust at 6% compared to 7% last year. And so generally we are quite bullish and positive on the growth prospects for this coming year. And I think that optimism is borne out by the composite index of economic activity. We do have that index. You can see for the first quarter of 2023, first quarter shows a growth of 5.1. I think that is consistent with what we expect, the 5.5% growth that we expect for the whole year. Now, again, just coming back to the agricultural recovery, these are just examples of what we expect and what has actually happened through May. Under horticultural exports, you can look at the performance, the volumes through May, and you can see that the blue line compared to the purple line is above, and therefore so far the volumes and growth of horticulture compared to last year is much higher this year. Similar story for milk. I think initially this year, the first 2 months, it was very difficult. It was hot and was very dry, so milk production had gone down. But you can see now since March, there's a huge actually recovery, and there's a big upswing in milk production. This is a table just summarizes what we expect on food crops. We expect maize to increase quite significantly compared to the contraction that was there in 2022. We also expect wheat, beans to also increase, Irish potatoes, basically most items to increase. The only one that there may be an issue with is rice, which we see a reduction in production of rice. On the manufacturing sector, again, this is just if you go back to the table on growth, you'll see that manufacturing, this one. You can see that manufacturing in 2022 growth was 2.7. We are expecting an acceleration in growth to 3.5. And the charts, go back to the charts, is just an indication or proxy for higher manufacturing activity. And you can see that total power consumption in the first 5 months, which is represented by the purple line, is well above the blue line. And similarly for the trend of large power consumers, the same pattern is there, that consumption in 2023 is above, in fact, it is above all other years, 2022 and 2021. On private sector credit, I think since March, you can see we've had credit to the private sector from the banking system has recovered quite nicely from the past several years. I know we are only showing from 2019, but I think if you go back even up to 2016, you see that growth to the private sector was very muted, may have been maybe around 4%. But since March of 2022, we have seen the credit to the private sector has picked up. Now, and since that time, you can see that it has been in double-digit territory. And for the 2 months, April and May, recorded quite a significant increase of 13.2%. So these are just specific examples of credit to some of the key sectors of the economy. You can see manufacturing, the last 2 months for April and May is quite robust. It's 21.7 and 19.3. Similarly, trade, and actually if you just go back to manufacturing, you can see that since January there's been an upward trend in credit to from the banking system to the manufacturing sector. Same thing with trade, again an upward trend up to 15.4%. Transport communication is also quite robust, and consumer durables continues to be double digit, but I think with maybe inflation last year, there may have been kind of a slowdown in consumer durables. Next. So this is the overall balance of payments. It's obviously you can't see this. It's difficult to see, but essentially, maybe just to summarize on the balance of payments, we do expect the current account deficit to narrow from 5.1% to 4.8% this year. We also do expect some significant inflows, both from the IMF and also from other development partners. And overall, we expect an overall balance of payments surplus of almost $200 million, and that is actually compared to a deficit last year of more than $2 billion. So this is a chart again showing exports and up to, it shows up to the year up to May, and from May of 2022 to May of 2023, I believe the growth rate is 5.5%. Again, just representing, just showing that export performance will be positive. That's up to May, of course. We still have to make projections up to the end of December, but so far so good. On imports, I believe. Okay, so this sorry, you can pass it. This is just the 12-month cumulative exports. This is also the 12-month cumulative imports in terms of dollars, just giving you different categories of imports: oil, chemicals, manufacturing, machinery, and others. Next slide. Travel receipts. Here you can see a significant recovery in travel receipts over the first 5 months. And indeed, if you look at the purple line of 2023, or the purple columns, you can see all of them from January, February, March, April, and May. They are all significantly higher than during the previous years. On transport receipts, here the they're still robust, but not as high as in the previous year. Again, here's the diaspora remittances. These have been a very steady source of foreign exchange, and you can see every year there's been a significant upward trend. For 2022-2023, there's a bit of a flattening out, and as I indicated earlier, most of about 57% of remittances come from the United States. And as we saw in the earlier table, where the growth of the U.S. economy is actually slowing down from 2.1 to 1.6. So this could be that slowdown of the U.S. economy may be part of the story explaining why there's a flattening of the diaspora remittances. Having said that, obviously in terms of Kenyan shillings, there will still be a significant increase given that the exchange rate has moved this year compared to last year. Okay, this is the current account. We already discussed the current account, but the important is to see is just the trend in the current account. I think for quite a number of years it's been roughly 5% to 5.5%, maybe from 2018. And it has now come down to 4.8% through May of this year, and our projections indicate that by the end of this year, by December, that the current account will be 4.8% compared to the 5.1% that was realized in 2022. So this is the CBK's usable foreign exchange. The current level as of June is 7 billion, almost 7.4 billion, and that's equivalent to 4.07 months of import cover. It's consistent with our statutory requirement, and it's fairly robust in terms of being a buffer against external shocks. So this is on the fiscal side. This is just to show the domestic debt performance. You can see that we were able to mobilize resources of up to 436 billion compared to a target of 475 billion. Meaning that we achieved the 92% target. Most of that borrowing is in T-bills. The share now of T-bills in total lending is about 87%, and only 13% is in T-bills. And also the average time to maturity for those treasury bonds is roughly about 9 years. On fiscal performance, this is the fiscal consolidation plan. You can see from 2020 to 2021, when the overall fiscal deficit was 8.2, it has been declining every year. This year, that ends this month, the deficit is estimated to be 5.8%. This includes the second supplementary budget and the budget that has been approved by Parliament, and the accompanying Fiscal Finance Act will result in a further narrowing of the fiscal deficit to 4.4% of GDP, and over the medium term we expect the deficit to narrow further to 3.6%. And all this will be with the idea of reducing the overall debt to GDP towards a sustainable level. And as you know, the Parliament has now agreed to having a debt anchor of 55% of net present value of debt to GDP. And this profile of fiscal consolidation and reducing the fiscal deficit should move us towards that level of debt to GDP. That's the fiscal framework. The numbers are not very clear. But essentially it's the same story as we just looked at, with the deficit this year being 5.8%, followed by the further consolidation to 4.4% next year, and over the medium term to reduce it to 3.6%. So I think that's it, and thank you very much.
Thank you very much, Governor. That was the Governor of the Central Bank of Kenya, who's also the Chairman of the Monetary Policy Committee, Dr. Kamau Thuge. And as is customary, we'll take your questions. There's quite a number of questions coming in. The reminder is to please send your questions through Slido. That's www.slido.com. The meeting is #MPC 0623. And like we said, we are keeping the questions on the Monetary Policy Committee decision, as well as sort of adjacent questions on the economy. So I'll begin with the first ones. Excuse me, Jimmy Mbogo from KTN is asking, what informed the decision to hike the CBR at a time when NPLs, that is non-performing loans, are rising? And what incentive will banks have to lend to the real economy? Kefa Moirore from the Business Daily, the surprise rate hike comes barely a month after the MPC met and held rates in May. Does this suggest that the MPC had not tightened policy enough previously? Charles Moniki from the Black Sea Grain Initiative next month. David Habling for the last one in this batch. David Habling from Bloomberg, by how many basis points do you see the new 16% VAT on petroleum products boosting the inflation rates? How are you prepared to fight second round effects? So we'll take those questions for now, and we'll take the further ones as they come.
Okay, let me start with the Kefa Moirore's question, which was the surprise rate hike comes barely a month after the MPC met and held rates in May. Does this suggest that the MPC had not tightened policy enough previously? I think as I explained, the information that the Monetary Policy Committee had when they made that decision to retain the rate at 9.5 was that it looked like inflation was actually coming down. It had come down from 9.2 to 7.9%. And even non-fuel had also declined. The internal projections were, in fact, that inflation would, the near-term inflation would continue to decline, and therefore, at that point when they made that decision, it was not that they had not tightened enough, but given the information that they had, perhaps it made sense not to further tighten monetary policy, given that rates were coming down and that it was expected to for further deceleration. Of course, as I have explained, since that time new information has become available, and indeed inflationary pressures have been rising. Inflationary expectations have increased, and therefore we found it very necessary to relook at the situation using the new data and new information, and that is what informed the Monetary Policy Committee decision to hike the CBR by 100 basis points. So to answer Mr. Jimmy Bogo's question, indeed NPLs have been rising. They are now at 14.9%. Now, it's important to note part of the reason for why the NPLs have been increasing. They are broadly, I would say broadly, they're into two areas. One is a business environment, and the other is the fact that the government, the national government as well as county governments have not been paying some of their suppliers. Now, the National Treasury has just gotten a lot of resources in the last, I would say, 1 month. They've gotten resources from the World Bank. The World Bank disbursed $1 billion from the development policy operation. Of course, they have also mobilized domestic resources through the infrastructure bond. And so we expect that the National Treasury will actually now spend and also transfer the resources that are required to the county governments. And with both county governments and the national government paying, we would expect that the level of non-performing loans will decline. In terms of the business environment, as I've said, I think the economy is looking up. The expenditure measures and the plans that have been budgeted for, and just basically in terms of the focus on growing the economy and the focus on the value chains in the budget, we expect that that will basically incentivize investors and result in more economic growth. As I said, we expect real GDP growth to accelerate from 4.8% last year to above 5%. And I think with that improved business climate, we would then expect also that to have a positive impact on the NPLs going forward. And there's a question by Charles Mwaniki, what is your outlook on inflation, considering the VAT changes on fuel and possible food price jump upon the end of the Black Sea Grain Initiative next month. We have looked at all these factors in terms of where we expect inflation to be. And we do think, for example, on the issue of the VAT, obviously there are also offsetting factors, as you are aware, that the import declaration fee has been reduced from 3.5 to 2.5. And similarly, the Rural Development Levy has also been reduced from, I believe it's to 2% to 1.5. So these will mitigate any impact that may arise from the VAT on fuel. But we do expect some increase in July. But overall, given the actions that we are now taking, we actually do expect that by August, earliest and latest by September, we expect the overall rate of inflation to come to below the upper range of 7.5 and to be firmly within our target range of between 2.5 and 7.5. From Bloomberg, the question is, by how many basis points do you see the new 16% VAT on petroleum products boosting the inflation rate? And how are we prepared to fight second round effects? I think, David, The fighting of the second round effects is precisely what we are trying to do with the increasing of the CBR from 9.5 to 10.5. As I emphasized even in my presentation, we are very concerned about the trend in the non-food, non-fuel inflation. For some time, it has been below 3%. It is now above 4%. And that increase also reflects the second round effects from the fuel and food prices. And indeed, again, we want to be able to bring down a non-food, non-fuel to below 3%, because we believe that an overall inflation of around 5% is consistent with non-food, non-fuel inflation of below 3%. I think those are the...
Thank you, Governor. The second batch of questions will begin with Rama Nyang from CGT and Africa. Rama asks, is the Central Bank of Kenya shepherding talks with banks on a domestic bond swap deal as part of efforts to reduce the Finance Ministry's debt service costs? Gerald Gekara from Uzalendo News, the new government-to-government deal for fuel importers, when do you expect to see the effects of that deal to our dollar reserves? Coming back to Rama Nyang of CGT and Africa, Rama is saying that two key markets, which is Egypt and Pakistan, are having significant dollar issues. How is that affecting dollar inflow? And is there a significant dollar receivables position built up?
So let me start with the first one. The CBK is shepherding talks with banks on a domestic bond swap deal as part of efforts to reduce the Finance Ministry's debt service costs. No, we're not shepherding any of those talks. I do believe that the fiscal framework of the National Treasury has incorporated all these the debt service payments, including the impact of a higher exchange rate, and as I just indicated earlier, they have a trend, they have a plan to reduce the overall fiscal deficit and to achieve a sustainable debt position and fiscal position over the medium term. On the issue of the new government-to-government deal for fuel importers, when do we expect to see the effects of that deal to our dollar reserves? I think the government-to-government or the G2G deal on fuel importers has obviously helped in terms of reducing pressures on the exchange rate. The total amount of dollars, at least demand in dollars that has been removed from the market is about $500 million per month. And obviously this has helped to reduce the gap between the demand and supply of dollars. Otherwise we may have had an even a deeper depreciation of the exchange rate. And maybe I take the issue of the impact on our dollar reserves together with this other question by Rama Nyang on Egypt and Pakistan and having significant dollar issues and how is that affecting dollar inflows. As I mentioned in my presentation, I'd rather look at this from a broader perspective, because ultimately what determines the inflow of dollars into the economy is the balance of payments. And as I did indicate, we expect exports to grow quite robustly. I already said that through May we had growth of exports by 5.5%. We have robust remittances, inflows. The services, tourism is doing quite well, and indeed we are getting disbursements from our development partners, and all this as I said earlier, will result in an overall balance of payment surplus of about $200 million, and that's compared to a deficit or an outflow of dollars last year of just slightly over $2 billion. That's it.
So we will take another two batches of questions. I'll begin with a question from David Herbling again from Bloomberg News. When do you see Kenya offering a dollar-denominated bond locally, and what size are you looking at? Justin Mwangi from SBG Securities is asking, was a rate hike partially meant to support the shilling as well? Ramanyang from CGTN, African economies accounted for 12% of Kenya's imports and 42% of exports in the first quarter of 2023. Can the Afreximbank PAPS system meaningfully cut Kenya's dollar demand? Finally, for these ones, Stella Swake from Standard Investment Bank. Two questions. How does CBK plan to support private sector credit growth amid jumbo rate hikes and high government securities yields, which continue to crowd out the sector? And she continues to ask, should we expect more rate hikes?
Let me start with the first question by David Hobling on whether Kenya will be offering a dollar-denominated bond locally. This is one of the issues I had discussed during my vetting, but it was more part in terms of this is one of the areas that we would like to explore. We will do it with the National Treasury to see whether it's doable, whether it works. But the whole idea really was to be able to mop up some of the maybe excess dollars that may be there. Also encourage maybe Kenyan diaspora to be able to come and invest in those bonds, and that would increase the supply of foreign exchange, which obviously would come to the national treasury first, and then obviously then it will go to the national treasury would switch or would swap shillings and give the central bank dollars and retain the shillings for their own expenditure. So it's discussion that we will have with the national treasury, and to see whether it can be done. There's a question from Justin Mwangi: was the rate hike partially meant to support the shilling as well? I would say that it will help support the shilling, although our main focus really was to try to address these inflationary expectations I've been mentioning, which have increased quite significantly between April and May. However, by the very fact that the CBR rate is higher, we would expect maybe even to attract foreign exchange to come into Kenya, and that could help support the Kenyan shilling. On the issue of the Afrexim Bank and whether that would meaningfully cut Kenya's dollar demand. We're in the midst of discussions with Afrexim Bank on how we can join this Pan-African payments and settlement system. Of course, as you know, we do have our own East African payments and settlement system, but definitely the PAPS would reduce the demand for dollars, and so we are looking very much forward to that discussion and how we move forward towards a PAPS in light of moving also towards the African continental free trade area. There's a question here by Stella. Whether the borrowing by the government will continue to crowd out the private sector, and should we expect more rate hikes? I think, Stella, if you look at the fiscal framework, especially for 23-24, and perhaps we'll have another discussion on this, because I believe that the estimated or the projected borrowing by government for the next financial year will be significantly less than this year, and significantly less than was indicated in the budget policy statement. And because it's so much lower, I do expect that as the government reduces its borrowing requirements, the banks will turn to lending to the private sector. So I am not so much concerned now about whether the government will crowd out the private sector, given the proposed reduction in the fiscal deficit from 5.8 to 4.4%, and over the medium term to 3.6. In fact, I think that fiscal consolidation plan will actually be crowding in rather than crowding out the private sector.
The last batch of questions, we'll begin with Duncan Mereri from Reuters. He is asking the governor to comment on the disparity between the policy rate and the yield curve, where Government of Kenya debt auctions are recording yields of more than 14%. Julian Zamboko from NTV Kenya asks how the numbers looking from an output gap standpoint, and how do you see this defining the MPC's conduct in the near term? Eric Mokaya from Mwango Capital, what impact do you expect on the economy and on inflation from the Finance Act 2023? And finally, Aristarchus Kuria from Neofin Entrepreneur, per your Parliament's vetting closing remark, first, when do you expect to have the microfinance bill passed? And two, your views on the MFB sector for transformation and transition.
Maybe I can start with Bwana Kuria. This microfinance bill, we submitted to Parliament actually last year, was submitted by Treasury last year. It had been approved by Cabinet, but Parliament has not moved on it. So indeed, I did mention it during my vetting, and we will, as CBK, be following up with the chairman of the Finance Committee to see how we can expedite this particular bill, because we obviously see the microfinance as a key sector for financial deepening and for financial inclusion as well. On the issue of the inflation, they are mitigating factors, but essentially we have looked at all the impact arising from the Finance Bill, Finance Act, now that it's an act. And so the actions that we have taken to raise the CBR rate is actually to address any potential impact those measures might have on inflation. Mr. Julian Amboko talks about how the numbers looking from an output gap standpoint, and how do you see this defining the MPC's conduct in the near term. Indeed, we have looked at the output gap, And we are almost, I think right now we are almost at the same level as the long-term growth of the economy. So the output gap is not that very much different. In 2020, obviously there was a big gap because of the COVID-19. Domestic production and real GDP growth actually was negative, and therefore was well below the trend, the long-term growth. So going forward, we believe that the real GDP growth is moving towards the long-term trend, and therefore there's a convergence in the two, and we really don't see the output gap being a determinant on whether we are going to raise interest rates or not, or in the sense where the real GDP growth maybe exceed the long-term growth and therefore exert inflationary pressures on the economy. We do see them right now going in pace, the two of them, without too much aggregate demand being over the long-term growth of the economy. There was a question about the disparity of the policy rate and the yield curve, where GOK debt actions are recording yields of more than 14%. Again, as I just indicated, I think the yields will slow down. I think as we go into the next financial year with enhanced revenue collection, with actually a cut in expenditures in terms of GDP, and in terms of reducing the government borrowing from the domestic economy, we expect yields actually to stabilize and perhaps even come down during the course of the year, and then we can see some kind of a convergence between the policy rate and the yields on the government debt.
Thank you, and that brings us neatly to the end of this post-MPC press conference. Just to remind you, this presser is after the MPC met yesterday, made a decision, and all those can be found on our website. This is a press release after the MPC, and lots of the documents that are related, including some of the publications, and this slide presentation will be made available to you through the usual channels, that is our website, and through other channels that you are welcome to. As we said at the beginning, we shall be having a press conference with the governor and the deputy governor within the next couple of weeks, so please be on the lookout for that, members of the media. And the MPC, as the governor indicated, will be meeting again in July in the usual cycle, and so we shall see you at either one of those two press conferences. But for now, we'd like to thank you, and do have yourselves a good afternoon.